Ladies and gentlemen, welcome back to Boss Economics World. I'm your host, continuing our deep dive into the economy while keeping a close watch on the government policies and corporate behaviors, which frankly, deserve nothing but scrutiny. Today, we have a particularly hot topic to dissect. Singapore's monetary authority fined JPMorgan Chase a hefty 2.4 million Singapore dollars for its failure to prevent and detect misconduct by its relationship managers in shady bond trades. This incident has unraveled deep-rooted issues in corporate governance, regulatory oversight, and financial ethics, all of which point to larger systemic economic concerns. So, let's use this case as a starting point to analyze the broader economic landscape, the government's regulatory approaches, and the implications of corporate malpractice on financial stability. Spoiler alert, this is not just about a few rogue traders at JPMorgan, it's about an ecosystem that allows such behavior to flourish. The question we should ask is, how deep does the rot go? Let's dig in. Singapore's regulatory body, the Monetary Authority of Singapore, MAS, slapped JPMorgan with a fine of 2.4 million Singapore dollars for failing to prevent and detect misconduct involving 24 OTC bond transactions between November 2018 and September 2019. What exactly happened? The relationship managers, the people responsible for keeping their wealthy clients happy, misrepresented the price components or omitted key information about the spreads charged over interbank prices. Here's the kicker, these spreads were higher than what had been bilaterally agreed with the clients. Essentially, JPMorgan's private bankers were overcharging their clients, a classic example of abuse of trust in an opaque over-the-counter (OTC) market. The MAS investigation showed that JPMorgan's system was riddled with gaps that allowed this misconduct to fly under the radar for nearly a year. JPMorgan has since admitted liability, paid the fine, and refunded the overcharged clients. They've also promised that they've improved their systems with internal controls, monitoring, and training programs. But the damage is done, and the fine, in reality, is peanuts compared to the risks and potential damage of this misconduct on the larger financial ecosystem. To understand why this misconduct happened, we first need to shed some light on the over-the-counter, OTC, bond markets. Unlike stocks traded on formal exchanges, the OTC bond market is notoriously opaque. This means that bond prices aren't displayed for everyone to see. Clients rely heavily on bankers and relationship managers to tell them the rates. In theory, interbank prices are supposed to be relayed honestly to the client, with a small spread, or profit margin, charged as an add-on. However, as seen in the JPMorgan case, relationship managers took advantage of this inherent opacity to charge spreads that far exceeded what was agreed with clients, capitalizing on the lack of price transparency in OTC trades. The question then arises, why does such opacity exist in modern markets, and is it even necessary? Some argue that this makes bond trading more flexible and offers customized trades for institutional and private investors alike. But in the age of digital markets, transparency should be paramount, and hiding behind opacity only opens the door for exploitation. It's no surprise that JPMorgan's misconduct happened in the OTC space, where it's far easier to cover your tracks. When I see incidents like this, I don't just blame individual actors, I step back and look at the incentives and regulatory framework that allows such behavior. And here's where the real problem lies. Inadequate enforcement combined with misguided or insufficient regulation. 1. Weak internal controls. JPMorgan acknowledged that their internal controls were insufficient. Why did it take a year for them to detect this problem? The simple answer is that financial institutions have little incentive to aggressively regulate their own people. Relationship managers, after all, are there to increase revenue, and often their own compensation is tied to transactional profits. This incentive structure can easily lead bankers to cut ethical corners, especially in markets where it's easy to fudge the numbers. 2. Soft regulatory enforcement. 2.4 million Singapore dollar may sound substantial, but when you think about it, this is a slap on the wrist for an institution like JPMorgan, which rakes in billions of revenue each year. The fine essentially amounts to loose change in the grand scale of things. Furthermore, fines like this won't deter future bad behavior if they pale in comparison to the profits earned. 3. Selective enforcement and the role of government. Every time we talk about corporate misconduct, the watchdogs bear a part of the responsibility. Why was JPMorgan allowed to slip through the cracks? We must remember that regulatory agencies are often undermanned and underfunded, not to mention sometimes too complacent. If oversight is seen as nothing more than a token effort, what incentive do companies really have to police themselves? This brings me to the larger, global picture. Corporate misconduct, whether it's in the form of mispricing bonds, manipulating interest rates, or facilitating money laundering, reflects deep cracks in the global financial system. And we've seen this story over and over again. Remember the 2008 global financial crisis? It wasn't just about unsavory loans, it was about an entire ecosystem, banks, regulators, rating agencies, getting too cozy with one another, prioritizing profit over sustainable growth and accountability. In the wake of the Lehman Brothers collapse and the subprime mortgage crisis, governments around the world promised us reform, stricter financial regulations, better oversight, and more transparent markets. But nearly 2 decades later, we're still seeing these kinds of incidents, suggesting that these reforms have only scratched the surface. Bankers will always find loopholes if regulators are not on high alert and consistently imposing meaningful repercussions. First, let's talk about the investors, especially wealthy private banking clients who are supposed to be the most sophisticated market players. The JPMorgan case is a stark reminder that no one is immune to being taken for a ride, not even those who employ wall-to-wall financial advisors. Investors need to demand more transparency in bond markets and, frankly, in any market that deals with financial securities. Ask the right questions, demand clarity, and scrutinize the terms of engagement. Now for the regulators. The MAS has acted, but such minor slaps on the wrist are not enough. Regulatory bodies around the world need to step up their game. If the financial system remains this opaque, we'll inevitably see more scandals that undermine public trust in the system. There's also the need to enhance whistleblower protections globally. Imagine how much earlier this problem could have been detected had there been an empowered and protected whistleblower mechanism in place. No one on the inside in these institutions dares to speak up, and that's a culture problem regulators need to fix. Finally, we need an overhaul of the incentive structures inside these financial institutions. You can create compliance procedures all you want, but if your bankers and traders earn bonuses based on the commissions they bring in, often incentivizing risk-taking and unethical decisions, then misconduct will continue. Why should we care about some overcharged clients in an obscure bond market deal? Because every incident like this chips away at the trust underlying the financial system. If ordinary investors can't trust banks to handle such basic transactions with transparency, trust in the broader financial ecosystem erodes. Markets run on trust, and any loss of trust can have a chilling effect on capital flow, investment, and overall economic stability. As we've seen in previous financial crises, seemingly small scandals have the ability to snowball, exposing systemic risks that bring entire economies to their knees. Moreover, in an era of slow economic recovery, rising interest rates, and geopolitical instability, the last thing we need are major financial scandals causing even more turmoil. Investor confidence is delicate, and economies cannot afford another credibility crisis in the banking sector, especially as we navigate an increasingly volatile and uncertain global economic landscape. There are no isolated incidents in modern economics, and the JPMorgan case in Singapore points to a broader issue. The global financial system is still riddled with opacity, structural flaws, and insufficient regulatory vigilance. The lessons of the 2008 financial crisis largely went unheeded, and here we are again, talking about corporate misconduct that puts clients, markets, and ultimately the stability of entire economies at risk. If governments and regulators don't take serious steps to tackle these problems head-on, we will continue to see more of the same. Band-aid fines and PR apologies simply won't cut it anymore. We need real reform, real enforcement, and a cultural shift within the financial sector in which ethical practices are championed over profit maximization at all costs. This is not just a warning for the wealthy elite or private banking clients, this is an issue that affects us all. The financial system touches every layer of the economy, and when it fails, the shocks resonate far and wide. Well, that wraps up today's analysis. But remember, stay alert. As always, economic issues run far deeper than the headlines, and it's our job to keep digging. Until next time, this is your host, and I'll see you soon for another dive into the dark corners of finance.